Welcome back to the Longacres Finance channel. It's time again to take a look at the top quality dividend stocks on my high growth dividend watchlist. This watchlist is designed to present me with the best investment ideas for fast growing, high quality dividend companies that are poised to offer strong total returns in the future. I believe that investing in quality companies trading for attractive prices is a winning long term strategy. Many famous investors practice this approach with great track records of success. In theory, this investing strategy is simple and makes sense. Great companies are bound to perform better than average or poor businesses, and buying great companies at attractive prices is the optimal path to take. But what's simple in theory is much more complex in practice. How do you determine which companies are better than others? And how do you figure out if they are priced attractively? That is the million-dollar question. The way I go about it is through a screening process designed specifically for high-growth dividend stocks. I start with a universe of over 3,000 companies and whittle this list down to just the top 15 stocks each month. I look for companies with economic moats and patterns of business growth, as well as a handful of specific dividend metrics. This usually gets me down to a list of about 100 stocks each month. I then rank the stocks based on business quality and use dividend yield theory to get a quick valuation measure. I also compute a future return estimate for each company based on future earnings growth, current valuation, and the dividend yield. Once I finish this process, I sort the stocks based on these three metrics, and select the top 15 that meet my minimum return requirement of 12% per year to be included in a given month's watchlist. This process has worked out pretty well for me, but I realize that not all of the stocks that appear on the watchlist will be long-term winners. There is no perfect system that can pick winners consistently. My process also only focuses on quantitative data and does not factor in any recent news developments for the chosen stocks. So it's prudent that if you use my watchlist, you perform due diligence on all of the presented stocks. Okay, let's have a look at the watchlist for March, and after I'll talk about past results for this watchlist. The chosen stocks for March are Charles Schwab, MasterCard, Monolithic Power Systems, Home Depot, Visa, Tractor Supply, Humana, Amphenol, FedEx, Sherwin-Williams, BlackRock, Cigna, CDW, Ball Corporation, and Texas Instruments. The average dividend yield for all 15 is 1.35% as of month-end February, with the average trailing dividend yield being 1.08%, suggesting that collectively these 15 stocks are potentially undervalued. Texas Instruments, BlackRock, and Home Depot offer the most attractive individual dividend yield, all above 2%, with a handful of the stocks this month offering sub 1% dividend yields. Keep in mind that while attractive dividend yields are nice, my main objective here is on total return, with the dividend being icing on the cake. Let me go down the list quickly and give you a little bit more color on each company. Charles Schwab has trended down about 13% since its last share price peak in early February. As a result, the dividend yield has ticked up about 20 basis points and sits just shy of 1%. Schwab raised its dividend earlier this year by 11%, which was a very good sign after the company failed to announce an increase in 2021. The dividend bump in 2020 was rather low, just shy of 6%. The long-term dividend growth rate remains very high, above 20%, but recent activity implies it will decline unless we see more attractive dividend hikes in the coming years. Dividend yield theory suggests the stock is still overvalued, but my return assumption remains attractive at the current share price. Schwab has been one of the best watchlist stocks, returning almost 66% during the last 18 months. MasterCard has had a pretty rough year, as the share price today is below the price from 1 year ago. The stock is down about 13% from its most recent high in early February. The dividend yield of 0.53% is about 5% better than the trailing dividend yield over the last 5 years. The company has been a dividend growth machine, with a decade of double-digit year-over-year dividend growth. 2022 dividend payments have also been increased by 11.3% from the prior year. I believe the stock is an attractive investment at today's price, and should offer strong total returns in the long term. Monolithic Power Systems peaked in mid-November 2021, and today trades almost 20% cheaper. Based on dividend yield theory, it still hasn't trended down to a fair value, but the forward-looking return assumption looks attractive enough to include the company on this month's watchlist. The company has a short but very strong dividend growth history, and more recently announced another 25% dividend hike. Home Depot is one of my favorite stocks and a store I frequently visit. The share price is down a little more than 21% since peaking in January of this year. This in turn has made the dividend yield look more attractive again at 2.4%. Dividend yield theory suggests the stock is about 14% undervalued right now, and the long-term return assumption looks pretty attractive. I will be adding to my position this month. Home Depot has a very good history of dividend growth, sustaining double-digit growth for more than a decade now. Last month, Home Depot announced another dividend hike of 15.15%, continuing the double-digit growth trend for another year. Visa is in a similar situation as MasterCard. With the share price struggling for the past year, the dividend yield is a little bit more attractive than MasterCard's at 0.68%, and dividend yield theory suggests the stock is potentially a little more undervalued than MasterCard. The 2021 year-over-year dividend growth rate clocked in just shy of 10%. This was the first sub 10% dividend growth rate for the stock since it started paying dividends in 2008. Long-term dividend growth looks very attractive, and the low payout ratio implies that this growth should continue in the foreseeable future. I think Visa looks attractive at today's prices and should offer very good total returns in the long run. Tractor Supply is also down about 13% since it peaked around year-end. Dividend yield theory suggests the stock is undervalued today, but this is a little skewed due to the monster dividend increase the company announced this year. In late January, Tractor Supply bumped its quarterly dividend by 76.9%, which was the largest ever dividend hike for the company. If we back out the latest dividend hike, the stock would potentially look overvalued, and with a more modest dividend bump, it would be about fairly valued. My return assumption is a little overstated based on the skewed valuation, but I think the stock is a solid long-term investment at today's price. The stock has been a very strong watchlist performer, returning almost 46% during the last 13 months. Humana today trades about 6.5% below its near-time high from December 2021. The stock took a nosedive early in January, falling about 22%, but has since recovered. Dividend yield theory suggests shares are still undervalued by about 12%. My return forecast is pointing to about a 14% long-term rate of return for the stock. Obviously, the stock was much more attractive when it traded below $400 in January, but I think it's still a good long-term opportunity today. Last month, Humana announced a 12.5% quarterly dividend increase that is in line with the last 4 dividend increases. Amphenol's share price peaked toward the end of 2021, and today the stock trades about 13% cheaper. Dividend yield theory suggests shares may be about 17% undervalued right now, and my return assumption sits just north of my minimum 12% target. Amphenol bumped its quarterly dividend payment up by 37.9% in October of 2021. Shareholders will likely have to wait till October to find out what increase management declares this year. FedEx share price is down about 30% since peaking in May of 2021. The past 9 months have been pretty painful for long-term shareholders. Dividend yield theory suggests the stock may be potentially 8% undervalued right now. My return assumption implies the stock makes long-term sense with an estimated 16% annual total return forecast. FedEx failed to increase its dividend in 2020. In fact, the quarterly dividend rate remained flat from June 2018 till June 2021, when the company announced a 15.4% quarterly dividend hike. Long-term dividend growth remains strong, and we will have to wait till June of this year to find out if there will be a 2022 dividend increase. Sherwin-Williams is down about 25% since its peak towards the end of 2021. Dividend yield theory suggests the stock is about 14% undervalued right now. I am forecasting a 14% long-term annual total return for the company. The company announced a 9% dividend increase last month that is below its long-term dividend growth rate, but perfectly respectable given its long dividend history. Shares of BlackRock are down about 24% since peaking early November 2021. This gives BlackRock a much more attractive dividend yield today of 2.6%. Of course, the 18% dividend hike announced in January of this year helped elevate the dividend yield as well. Dividend yield theory suggests the stock is about 12% undervalued now, and poised for a 14% long-term annual total return. Cigna is appearing on this watchlist for the very first time. The company switched its tiny 4-cent annual dividend to a $1 quarterly dividend in 2021. More recently, it also increased the quarterly dividend by 12% to $1.12 per share. This accelerated dividend growth renders dividend yield theory ineffective as a valuation measure. In fact, it suggests the stock is about 99% undervalued, which is completely wrong. It also heavily skews my future return forecast. Shares of the company are down about 10% since May of 2021. The current dividend yield of 1.92% makes the company look attractive on this watchlist. The stock is a strong buy for Wall Street analysts, which is primarily why I included it on the watchlist. But I will have to take a much deeper look at the company before I decide whether it's a good long-term investment. CDW is down about 16% since early January, and looks to be about 11% undervalued based on dividend yield theory. The company announced a very good 25% dividend increase in November of last year, as it continues to maintain a double-digit annual dividend growth rate since 2014. Ball Corporation is down about 9% since its near-term high at the end of January. The share price has experienced volatility during the last year, but remains pretty flat in terms of growth. Dividend yield theory suggests the stock is about 8% undervalued right now. The company announced a very nice 33% dividend increase last year, but it has a relatively short dividend growth history. Shares of Texas Instruments are down about 15% since December of 2021. The current dividend yield of 2.69% looks pretty attractive, and dividend yield theory suggests the stock is about 12% undervalued. The dividend yield has not reached this range since late 2020. There were opportunities to pick up shares with a 3% plus dividend yield early in 2020, but those days of market volatility are long gone. The company increased its dividend by a solid 12.75% in 2021, as it is on an 11-year double-digit dividend growth streak. Texas Instruments is a large position in my portfolio, and I have been adding to it during the recent price weakness. There you have it, my top 15 high-growth dividend stocks for March. Many of these companies are repeats from prior watchlists. But with all the volatility this year, I have seen a few older names popping up again as their prices become more attractive. The top 15 stocks from the February watchlist had a pretty rough month, losing 5.31% on average. This was significantly worse than VIG and SPY that both lost less than 3%. The watchlist is off to a poor start this year, with a year-to-date loss of 9.1% through month-end February. SPY is down 8.06% during the same time period, and VIG is down 7.95%. The long-term annualized rate of return for the watchlist has also come down quite a bit from a few months ago. It currently sits at 18.49%, so there's still a cushion above my target 12% return. I think if the market volatility continues for a prolonged period, the annualized rate may dip below 12%, which would be okay for me, because short-term volatility means extra gains in the long term, as I can buy up a few stocks at discounted prices. The worst return in February came from Home Depot, that lost 13.94%. BlackRock and CDW also performed quite poorly, losing nearly 10% each. Only one of the 15 watchlist stocks for February finished last month with a positive return. Rollins, which was a new addition to the watchlist last month, added a gain of 6.11%. It certainly helped cushion the bad performance, but wasn't quite enough to bring the watchlist in line with the overall market. Looking at past individual watchlist performance, the first 8 watchlists from September 2020 to April 2021 are currently sitting above my target 12% annualized return. All of these watchlists, with the exception of April 2021, have at least 12 months of return history. The remaining watchlists from May 2021 forward are not looking very good right now, but taking into consideration the recent pullback in the market, this is somewhat expected. I'll patiently wait to judge the results after a long enough period of time. The best watchlist stock is Nvidia, with an 82.78% total return since April 2021. In second place, we have Charles Schwab with a 65.96% total return since February of 2021. And in third place, we have Bank of New York Mellon with a total return of 57.74% since September of 2020. Nvidia was the first and only stock on this watchlist to cross the 100% total returns threshold. It peaked at just north of 144% at the end of November 2021. I'll be curious to see if they will be the first to cross 100% once more, or if another watchlist stock will mount a challenge to knock them out of first place. That's it for today. Thank you for watching. If you liked the video, please give it a like and subscribe to the channel so you don't miss future content. See you next time.